If you've been listening to the news with reports of rising crude oil prices, surging copper prices, and the potential inflationary impact of rising food prices, the recent surge in chocolate is the only extreme example here, and gold hitting record highs, you might be surprised to learn that the average Australian commodity export price fell 4% through March. In March, met coal saw the largest correction, falling 19%, closely followed by iron ore, which lost 11%. Both iron ore and met coal are critical inputs into the Chinese blast furnaces that make steel, and so both tightly aligned to the fortunes of the Chinese steel industry. By contrast, thermal coal, which is burnt for power generation, lost less than 2% in the month. But note, thermal coal is down almost 31% in the year, having started its correction much earlier than the other two. Then there is crude oil, where on the back of the ongoing conflict in the Middle East, recovering global industrial production, and the production quotas from OPEC saw prices lift more than 7% through March. Rising energy prices are an important factor in the formation of inflationary expectations. So when combined with the push back in the rate cut expectations from the Fed, it's not surprising that gold prices are up 4% through the month to a new record high. This rally continued into April as gold finds greater appeal in times of increasing uncertainty and accelerating inflation. Turning to base metals, this contrast between economic fundamentals and individual market factors are just as apparent, even those metals are critical inputs into the production process, and so should have a much tighter relationship with the economic cycle. Through March, Westpac's base metal index gained just 1%. On the positive side, we saw a 6% lift in aluminium, while copper was up 4%. However, nickel lost 7% in March to be down 30% in a year. So why has nickel, which is a critical input for the decarbonisation transition due to its use in batteries, collapsed, while copper and aluminium continue to rally? For copper, the rally in prices reflects the fading negative fundamentals and continuing disappointment in mine production. Westpac's longer-term view on the red metal remains constructive, based on rising demand from electrification as the world decarbonises. However, earlier this year, there were some cyclical headwinds holding prices back. This included the failure of the hope for improvement in Chinese housing, the less robust than expected lift in US and EU demand, and the pushing back of rate cut expectations from the US Federal Reserve. But from the supply side, copper continues to look very attractive, with ongoing material downgrades in mine production guidance pointing to a tighter market. Also on the positive side is that the copper pipeline continues to shrink. Getting copper projects off the ground is becoming increasingly difficult, and we continue to observe miners consistently being over-optimistic about project commencement dates and estimated output growth. Turning to nickel, we have seen that its history of being a boom-bust commodity is far from over. I have to admit that I too thought the demand for nickel as an input into batteries may have broken this history. Having grown up in Perth in the shadow of the Poseidon nickel bubble of the 1970s, I should have known much better. The most recent bubble in nickel was back in 2007, when prices surged to around $53,000 a tonne, as China's appetite for stainless steel could not be sated. Back then, it was the introduction of Indonesian nickel pig iron, made from nickel-rich laterites that Indonesia is well endowed with, that saw nickel prices halve to $26,000 a tonne. This time, we have again seen a surge in Indonesian nickel supplies, but the change has come from China developing a way to use lower-grade Indonesian nickel in batteries. China invested heavily in Indonesian nickel mining and refining capacity, significantly increasing supplies and thus suppressing prices. While the demand for nickel is rising, it remains a niche market with the potential for ample supplies as prices rise. So at least for now, nickel remains a speculative boom-bust commodity. So, should we be bullish or bearish for commodities overall? For Australia's major commodity exports, the outlook is bearish. For iron ore and met coal, Chinese steel production peaked in 2020 and has since been trending down. Through the last year, iron ore supplies have grown from Brazil and other non-traditional sources, which includes the Simandou in Guinea, which will begin production in 2025, and will continue to push prices lower. Met coal may have less supply options, but the Chinese steel prices remain under pressure, and thus there is little upside here. There will be some offset from stronger copper and gold prices, as well as potentially higher crude oil and LNG prices, but these will not be enough to offset falling prices for our bulk commodities. We expect Australia's average export commodity prices to be down around 10% by June 2025, which means a lower terms of trade, that is export prices relative to import prices being lower, impacting negatively on the profitability of our resources sector and perhaps more importantly, the taxation revenue of the Commonwealth Government.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published, or reproduced in whole or in part without the prior written permission of Westpac.